Question 1. Interest received from which of the following bonds is typically exempt from federal income tax? A. Corporate bonds. B. U.S. Treasury bonds. C. Municipal bonds. D. Agency bonds. Answer: C. Municipal bonds. The primary characteristic of municipal bonds that appeals to investors is the tax exemption of the interest received at the federal level, and often at the state and local levels if the investor lives in the issuing municipality. This tax advantage can make municipal bonds attractive, especially to investors in higher tax brackets. While capital gains from selling municipal bonds are generally taxable, the periodic interest payments are the key benefit. Remember, this tax exemption is a significant difference between municipal bonds and most other types of bonds like corporate or treasury bonds. Question 2. Which type of municipal bond is supported by the full faith, credit, and taxing power of the issuer? A. Revenue bonds. B. Industrial development revenue bonds. C. General obligation bonds. D. Special assessment bonds. Answer: C. General obligation bonds. General obligation, GO, bonds are issued by municipalities and are secured by the issuer's promise to pay, backed by their full power to tax residents and businesses. This broad taxing authority provides a strong backing for the bond, making it dependent on the financial health and tax base of the municipality. Unlike revenue bonds which rely on specific project revenues, GO bonds depend on the general taxing authority of the issuer. Think of GO bonds as being backed by the government's general power to collect taxes from its citizens. Question 3. What is the primary source of repayment for a municipal revenue bond? A. Ad valorem taxes. B. Sales tax revenues. C. Specific user fees or revenues from the project funded by the bond. D. Property taxes. Answer: C. Specific user fees or revenues from the project funded by the bond. Revenue bonds are issued to finance specific projects, such as toll roads, bridges, airports, or water treatment plants, and the debt is repaid solely from the revenues generated by that specific project. The bondholders do not have a claim on the issuer's general taxing power. For example, a toll road revenue bond is repaid from the tolls collected from drivers using that road. Understanding the revenue source is crucial because the bond's safety depends entirely on the project's ability to generate sufficient income. Question 4. Which entity is responsible for regulating municipal securities firms, including broker-dealers and municipal advisors? A. Financial Industry Regulatory Authority, FINRA. B. Securities and Exchange Commission, SEC. C. Municipal Securities Rulemaking Board, MSRB. D. Federal Reserve Board, FRB. Answer: C. Municipal Securities Rulemaking Board, MSRB. The MSRB is the self-regulatory organization responsible for creating rules for municipal securities firms and professionals. While FINRA enforces MSRB rules on broker-dealers and the SEC oversees the MSRB is the rulemaking body itself. The MSRB's rules cover various aspects of the municipal securities market, such as trading practices, sales practices, and professional conduct. Remember, the MSRB writes the rules, but other bodies like FINRA and the SEC enforce them. Question 5. An investor purchases a municipal bond at a discount in the secondary market. What is the tax treatment of the accredited discount? A. It is treated as interest income and is tax-exempt. B. It is treated as a capital gain when the bond matures or is sold. C. It is accreted annually and increases the cost basis. The accretion is taxable as ordinary income each year. D. It is accreted annually and increases the cost basis. The accretion is tax-exempt. Answer: D. It is accreted annually and increases the cost basis. The accretion is tax-exempt. When a municipal bond is purchased at a discount in the secondary market, the discount is accreted annually, meaning a portion of the discount is recognized as income each year. This annual accretion increases the bond's cost basis towards par. For municipal bonds, this accreted amount is treated as tax-exempt interest, similar to the periodic coupon payments. This means the increase in value as the bond approaches maturity is not taxed annually. Question 6. Which document is prepared by the issuer and provides potential investors with detailed information about a new municipal bond offering? A. Prospectus. B. Summary prospectus. C. Official statement. D. Indenture. Answer: C. Official statement. The official statement is the primary disclosure document for a new municipal bond issue, similar to a prospectus for corporate securities. It provides comprehensive information about the issuer, the project being financed, the terms of the bond issue, and relevant financial data. Investors should review the official statement carefully to understand the risks and characteristics of the bond before investing. Think of it as the essential guide to a new municipal bond offering. Question 7. An investor is in a high federal tax bracket and is concerned about minimizing current income tax. Which type of bond would likely be most suitable for this investor? A. Corporate bond. B. U.S. Treasury bond. C. Municipal bond. D. Agency bond. Answer: C. Municipal bond. For investors in high tax brackets, the tax-exempt nature of interest income from municipal bonds is a major advantage. By investing in municipal bonds, they can receive income that is not subject to federal income tax, effectively providing a higher after-tax yield compared to taxable bonds with similar pre-tax yields. Suitability is key here. An advisor must consider the client's tax situation. The higher the tax bracket, the more valuable the tax exemption becomes. Question 8. A municipal bond issue where the interest and principal payments are guaranteed by a third party, such as an insurance company, is known as A. Insured bond. B. Guaranteed bond. C. Double-barreled bond. D. Moral obligation bond. Answer: A. Insured bond. An insured municipal bond is one where a bond insurance company contractually guarantees the payment of principal and interest if the issuer defaults. This insurance provides an added layer of security for bondholders and typically results in a higher credit rating for the bond issue than the issuer would receive on its own. The insurance policy is a third-party guarantee that enhances the bond's safety. Question 9. Which risk is most associated with the potential for interest rates to rise after a bond has been purchased, causing the bond's market value to fall? A. Credit risk. B. Liquidity risk. C. Call risk. D. Interest rate risk. Answer: D. Interest rate risk. Interest rate risk is the potential for a bond's market value to decline due to an increase in prevailing market interest rates. When interest rates rise, newly issued bonds offer higher yields, making older bonds with lower yields less attractive and causing their prices to drop in the secondary market. This risk is particularly relevant for long-term bonds, as their prices are more sensitive to interest rate changes. Remember the inverse relationship: interest rates go up, bond prices go down, and vice versa. Question 10. What is call risk in relation to a municipal bond? A. The risk that the issuer may default on interest or principal payments. B. The risk that the bond may be redeemed by the issuer prior to maturity. C. The risk that the bond cannot be easily sold in the secondary market. D. The risk that the bond's value will decrease if interest rates rise. Answer: B. The risk that the bond may be redeemed by the issuer prior to maturity. Call risk is the risk that a bond issuer may redeem a callable bond before its scheduled maturity date. Issuers typically call bonds when interest rates have fallen, allowing them to refinance their debt at lower costs. This can be disadvantageous for the investor, as they lose the future interest payments on the called bond and may have to reinvest the principal at lower prevailing interest rates. Investors should check the bond's call provisions before purchasing. Question 11. A municipal bond that is backed by both the specific revenues from the project being financed and the full faith, credit, and taxing power of the issuer is called A. Revenue bond. B. General obligation bond. C. Double-barreled bond. D. Special tax bond. Answer: C. Double-barreled bond. A double-barreled bond is a municipal bond that has two sources of repayment. The primary source is the revenue generated by the project being financed, like a revenue bond, but it is also backed by the general obligation of the issuer. This dual backing provides additional security compared to a pure revenue bond, as the issuer's taxing power serves as a fallback if the project revenues are insufficient. It combines elements of both revenue and go bonds. Question 12. Under MSRB rules, when must a broker-dealer deliver an official statement to a customer in a new issue municipal bond offering? A. Only upon request from the customer. B. No later than the settlement date. C. Within 30 days of the trade date. D. Only if the issue is negotiated, not competitive. Answer: B. No later than the settlement date. MSRB rules require that broker-dealers participating in a new municipal bond issue deliver a final official statement to purchasers no later than the settlement date of the transaction. This ensures investors receive the critical disclosure document before they are required to pay for the bond. Providing the official statement by settlement allows investors time to review the details after the commitment but before the payment is due. Question 13. Which type of municipal bond finances a facility, often privately owned, but is issued by a municipality? A. General obligation bond. B. Revenue bond. C. Industrial Development Revenue Bond, IDR. D. Tax Anticipation Note, TAN. Answer: C. Industrial Development Revenue Bond, IDR. Industrial Development Revenue Bonds, IDRs, sometimes called Industrial Revenue Bonds, IRBs, are municipal bonds issued to finance the construction or acquisition of industrial, commercial, or manufacturing facilities that are then leased or sold to a private company. Although issued by the municipality, the debt service is typically the responsibility of the private company, and in many cases, the interest income may be taxable to bondholders. These bonds essentially allow a private entity to benefit from the municipality's ability to issue bonds, but their specific tax treatment can vary. Question 14. A municipal bond's total return includes both the periodic interest payments and any capital gain or loss upon sale or maturity. If an investor sells a municipal bond before maturity for more than their adjusted cost basis, how is the profit treated for federal income tax purposes? A. It is treated as tax-exempt income. B. It is treated as a taxable capital gain. C. It is treated as ordinary income. D. It is treated as a tax-exempt return of principal. Answer: B. It is treated as a taxable capital gain. While the interest income from most municipal bonds is exempt from federal income tax, any capital gain realized from selling a municipal bond for a price higher than the investor's adjusted cost basis is generally subject to federal capital gains tax. Similarly, a capital loss from selling below the cost basis can typically be used to offset capital gains. Remember the distinction: interest is usually tax-free, but gains from selling are usually taxable. Question 15. A municipal bond's yield to maturity reflects the total return anticipated if the bond is held until it matures. What does yield to call represent? A. The bond's current yield based on its market price. B. The total return anticipated if the bond is held until its first call date. C. The stated interest rate on the bond. D. The bond's yield without considering any discount or premium. Answer: B. The total return anticipated if the bond is held until its first call date. Yield to call calculates the return an investor would receive if a callable bond is called by the issuer on its specified call date, rather than held until maturity. It assumes the bond is called and factors in the call price and the time until the call date. Investors should consider yield to call, especially if the bond is selling at a premium, as the bond is likely to be called if rates fall, and the investor would receive less than par at the call date. Question 16. Which of the following risks is unique or more pronounced for revenue bonds compared to general obligation bonds? A. Interest rate risk. B. Credit risk related to the specific project's ability to generate revenue. C. Inflation risk. D. Market risk. Answer: B. Credit risk related to the specific project's ability to generate revenue. Revenue bonds carry a specific type of credit risk tied directly to the financial success and revenue generation of the project they funded. If the airport, toll road, or hospital project does not generate sufficient revenue, the issuer may not be able to make debt service payments, leading to a default. General obligation bonds, backed by the broader taxing power, spread this credit risk across the entire tax base, making the specific project's success less critical for repayment. Question 17. What is the purpose of the MSRB's Rule G37? A. To govern advertising of municipal securities. B. To restrict political contributions by municipal finance professionals. C. To establish suitability requirements for municipal bond recommendations. D. To regulate the content of official statements. Answer: B. To restrict political contributions by municipal finance professionals. MSRB Rule G37 specifically deals with political contributions by municipal finance professionals, MFPs, and municipal securities dealers. The rule aims to prevent pay-to-play practices, where firms or individuals make political contributions to influence the awarding of municipal securities business. If certain contributions are made, the firm may be prohibited from engaging in municipal securities business with that issuer for a period of time. Question 18. A bond resolution or trust indenture for a municipal revenue bond outlines: A. The taxing authority backing the bond. B. The specific revenues that will be used to repay the bond and the priority of those revenues. C. The political contributions made by the issuer. D. The amount of property taxes collected by the municipality. Answer: B. The specific revenues that will be used to repay the bond and the priority of those revenues. The bond resolution or trust indenture for a revenue bond is a legal document that details the terms of the bond issue, including the specific pledged revenues that will be used to repay the bondholders. It also establishes the priority of those revenues, example is debt service paid before or after operating expenses, and outlines any covenants or restrictions. This document is essential for understanding the security and structure of a revenue bond. Question 19. What is a potential disadvantage for an investor buying a municipal bond at a significant premium? A. The interest received may be taxable. B. The yield to maturity will be higher than the coupon rate. C. A portion of the premium must be amortized annually, reducing the cost basis, and this amortization is not tax deductible. D. The bond is more likely to default. Answer: C. A portion of the premium must be amortized annually, reducing the cost basis, and this amortization is not tax deductible. When a municipal bond is bought at a premium, above par, the investor must amortize the premium over the life of the bond, which reduces the bond's cost basis down towards par. This amortization represents a return of the excess amount paid over par. While the periodic interest received is still tax-exempt, the annual amortization of the premium is not tax-deductible against ordinary income. This non-deductible reduction in cost basis effectively reduces the bond's tax-exempt yield. Question 20. Which of the following is not a type of municipal bond? A. General obligation bond. B. Revenue bond. C. Mortgage-backed security, MBS. D. Industrial Development Revenue Bond. Answer: C. Mortgage-backed security, MBS. Mortgage-backed securities, MBS, are debt obligations that represent claims to the cash flows from mortgage loans, typically pooled together and sold as securities. While they are fixed-income investments, they are issued by entities like government-sponsored enterprises, Fannie Mae, Freddie Mac, or private financial institutions, not by municipalities to finance public projects. GO bonds, revenue bonds, and IDRs are all categories of municipal bonds. Question 21. What does a net revenue pledge for a municipal revenue bond mean? A. Debt service is paid from gross revenues before operating and maintenance expenses. B. Debt service is paid from gross revenues after operating and maintenance expenses. C. Debt service is paid only from excess revenues after all other obligations. D. Debt service is paid from the general taxing authority if revenues are insufficient. Answer: B. Debt service is paid from gross revenues after operating and maintenance expenses. A net revenue pledge is a common arrangement for municipal revenue bonds where debt service payments, principal and interest, are paid from the project's gross revenues after the costs of operating and maintaining the facility have been deducted. This means operating expenses have a higher priority claim on revenues than debt service. Conversely, a gross revenue pledge pays debt service before operating expenses. Understanding the revenue pledge helps assess the bond's security. Question 22. Under MSRB rules, a customer confirmation for a municipal bond trade must include: A. The name of the broker-dealer, the customer's name, and a description of the security. B. The marketability of the bond. C. A statement guaranteeing the tax-exempt status of the interest. D. An opinion on the future price performance of the bond. Answer: A. The name of the broker-dealer, the customer's name, and a description of the security. MSRB rules require that municipal securities confirmations provide essential details about the transaction, including the name of the firm handling the trade, the customer's identity, a clear description of the municipal security, issuer, coupon rate, maturity date, etc., the trade date, settlement date, price, and dollar amount of the transaction. The confirmation ensures the customer receives accurate information about the trade. Question 23. What is a moral obligation bond? A. A bond secured by specific assets of the issuer. B. A bond where the issuer has a moral, but not legal, obligation to appropriate funds to pay debt service if revenues are insufficient. C. A bond backed by the full faith and credit of the U.S. government. D. A bond issued for ethical or socially responsible projects. Answer: B. A bond where the issuer has a moral, but not legal, obligation to appropriate funds to pay debt service if revenues are insufficient. A moral obligation bond is typically a revenue bond where the state legislature has a moral responsibility, but not a legal requirement, to make up any debt service shortfalls. If the project's revenues are insufficient, the state may appropriate funds to prevent default, but it is not legally obligated to do so. Investors should be aware that this promise is not a legally enforceable pledge. Question 24. Which term refers to a municipal bond that is sold with a yield that is higher than its coupon rate? A. Premium bond. B. Par bond. C. Discount bond. D. Callable bond. Answer: C. Discount bond. A municipal bond is trading at a discount when its market price is below its par value, typically $1,000. When a bond is purchased at a discount, the investor receives a yield to maturity that is higher than the stated coupon rate because the investor not only receives the coupon payments but also makes a gain, the discount, when the bond matures at par. Conversely, a bond selling at a premium has a yield to maturity lower than its coupon rate. Question 25. Under MSRB rules, what is a key consideration for a registered representative when recommending a municipal bond to a customer? A. The issuer's bond rating is the sole determinant of suitability. B. The recommendation must be based solely on the tax-exempt status of the interest. C. The recommendation must be suitable based on the customer's financial situation, tax status, investment objectives, and risk tolerance. D. The recommendation must primarily benefit the broker-dealer. Answer: C. The recommendation must be suitable based on the customer's financial situation, tax status, investment objectives, and risk tolerance. MSRB Rule G-19, the suitability rule, requires broker-dealers and their representatives to have a reasonable basis for believing that a recommended transaction or investment strategy involving municipal securities is suitable for the customer. This assessment must be based on knowing the customer's investment profile, which includes their financial status, example income, net worth, tax situation, investment objectives, example income, capital preservation, and risk tolerance. Always understand your customer before making a recommendation.